Welcome to Protecting All of Your Equity. This is Aiello, and I will be your presenter. And this presentation now will not be too long, but it should be very informative. So you want to hang in there and enjoy it. This is a copyrighted presentation of ISU, Information Services Unlimited, all rights reserved. All right, we're going to talk about how to totally protect all your family assets from lawsuits and sue-happy lawyers without expensive, confusing structural mazes that a rocket scientist can't understand. Now, why asset protection? Well, you can be sued by anyone at any time for any reason, even if you do everything right and you're totally innocent. You should do things right, but you still can be sued. One lawsuit, can wipe out you and your family, and it happens. There are 82,000 lawsuits that are filed daily. That's daily, and many of them are frivolous, meaning they have no substance, no foundation, but the court system still hears them because it's a money-making proposition for everybody. It's not if you'll be sued, it's when. And the target is your equity, and real estate investors and business owners are prime targets. And even if you win the lawsuit, you can still be wiped out by the legal costs and business losses, like the dry cleaners over a $54 million pair of pants. And what happened is this person, who, by the way, was a judge, the dry cleaners, lost his pants, so he sued for the pants worth $54 million. Now, eventually, the dry cleaning business prevailed, but because of the legal cost, the strain, and the business losses, they went out of business. So we want to prevent a lawsuit altogether, and we're going to teach you how to do that. Now, what is asset protection? It's protecting you from demons. Well, first, let me tell you what it's not. It's not defrauding legitimate creditors or trying to abscond from legitimate creditors who should be paid. It's protecting you from demons like that claimant with a pair of pants, or sue-happy lawyers, or aggressive, wrongful creditors, and the like. You know, it's really total wealth protection. And total wealth protection encompasses everything: lawsuit protection, financial privacy, entity structuring, income tax reduction, IRS audit proofing, estate planning, investment planning, and equity protection. And I will tell you, not many are teaching equity protection, and you'll see why. Now, what has asset protection become today? It's become an industry, a racket, with conflicting, confusing, incomplete, inaccurate information, with complex, costly, convoluted mazes of myriads of entities a rocket scientist can't understand. And have you ever seen this type of structure, and this, and this, and this, and this? Well, this is expensive, it's confusing, burdensome. Believe it or not, it doesn't totally protect you. Loss of tax savings and IRS problems. And, you know, I like the total approach. You know, we look at the legal side, the tax side, the IRS side. Sometimes these structures, you know, they may not be too bad legally, although they're confusing, but then there could be the loss of tax savings and IRS audit risk. This is basically my structure. 2 LLCs, maybe 3 LLCs, an asset protection trust, asset protection trust, a couple other minor things, much simpler, not expensive, not confusing, not burdensome, totally protects you. We look at the full picture: legal, tax, IRS, so there's no loss in tax savings, IRS audit proofing. Now, if you totally leave your asset protection needs up to most attorneys or CPAs, you very well may end up broke. I mean, it's a plain hard fact that most attorneys and CPAs know little about asset protection, especially for real estate investors. Yet they'll still sock you with high fees for doing a lousy job. You know, some of the emails I get from my students will appall you of the horrible, costly advice they're getting from their CPA or attorney. Now, while you want to use professionals to do the detail, you need to have a firm handle on your plan, because nobody cares more about your money than you. All successful entrepreneurs learn to protect their assets. Now let's talk about the risk in real estate. Yeah, financial risk. I mean, if you're well educated, real estate could be a high return, low risk investment. I'm not talking about that. I'm talking about liability risk. Real estate is a physical appreciating asset exposed to hazards, subject to government regulations, interacting with many tenants, contractors, vendors, suppliers, others, all who could be potential litigants against you in a lawsuit. Real estate is a high liability risk asset. And it's the ownership equity that causes the high liability risk. Let me repeat that. The ownership of the deed with the equity that causes the high liability, because that's what claimants want, the equity. That's where the money is. Now, these are you should have liability insurance, absolutely, but these are the liabilities not covered by insurance. Environmental, lead paint, radon, asbestos, mold, whatever else is on the horizon, fair housing violations, federal and state, even unintentional, innocent ones, other government disputes with HUD, the state, the city, tenant disputes over leases, management procedures, anything, disputes with buyers or sellers over agreements, anything, contractors disputes over fees, work performed, resulting in mechanical contractors getting injured on your property and suing you, building, supplier disputes over materials, pricing, other business disputes with real estate agents, management companies, title companies, you name it. Any one of these uninsured liabilities could lead to an action costing you thousands, tens of thousands of dollars, could even go into the millions. And even with insurance, liability may exceed limits. Or the insurance company may try to wiggle out paying the claim. This has happened. Read the fine print. Now let's talk about what LLCs and all other entities protect and what they don't protect. On the right-hand side of the screen tells you what they protect. Properly structured, an LLC will protect your assets outside the LLC, your home, your vehicles, your savings, your other personal assets. Protect your equity within the entity. So this is a problem. Unprotected equity costing you hard-earned equity, tens of thousands of dollars. Sure, you all heard of veil piercing. This is when a court ignores the entity and reaches the personal assets of the members. Very common. The best defenses are adhering to entity formalities like keeping minutes, etc., and equity stripping of the personal assets of the members. Now, there's something also called reverse veil piercing. This is where the creditors seek to reach the assets, equity of the entity to satisfy a judgment against the individual member. The best and only defense is equity stripping of the entity assets. Now, equity stripping is using another LLC to create in your real estate LLC, so there is no equity and no target for claimants. Let's look at unprotected equity in an entity. We have 6 properties in one LLC, value $1 million, bank debt $400,000, your equity $600,000. That's a huge target for claimants. Hey, if that were $60,000, still be a big target. So that's what they want, your equity. Now the bank debt, do they want that? No, that's debt. They don't want to sue for debt. But is that bank debt equity? Yes, it's not your equity. It's the bank's equity in a separate company, like we have there. So why not do the same thing for your $600,000? Why not convert that to debt, which claimants don't want, and make it equity in a separate bank? And that's what we're going to do. Equity stripping Excel, ESE, is using two separate entities, LLCs, with all necessary documents to transfer your equity to a safe place. It excels. It's a superior technique of using debt of your own lender company, LLC, to strip out the positive equity of your real estate with the end result of no, even negative equity, no target for sue happy lawyers. So you protect your equity by moving it out to a very low risk entity. Now look what we have. Instead of the $600,000 equity, we got debt, a second mortgage. There's no equity, no target. It is now in your lender LLC as equity. So unlike the $400,000 first bank mortgage, the $600,000 equity in the form of a mortgage is going to be your mortgage asset. You will be the mortgage company. You'll be the lender, the bank. You still own the equity, but without the risk of having the deed in this lender LLC while you still have your equity. Sound good, guys? It is. You are converting your equity, which claimants want, into debt, which claimants do not want, yet the debt is still your equity, but outside the real estate LLC in another lender LLC, protected from claimants and their ambulance-chasing lawyers. You take your equity out, yet leave the deed in. You control and reap all the wealth building and tax benefits from real estate by owning the deed. You know, Real Estate 101, the deed gives you total control, all the bundle of rights. So that's what you have, the deed, but without the risk of having the equity in the real estate LLC. Now, using debt is an age-old technique to claimants, and proven technique, because who wants to sue someone in debt? You know, lawyers want blood, not bones. How many times have you heard, say, a landlord say about a former non-paying tenant, it was not worth it to sue that deadbeat because they had nothing of value? Or a business person about their bookkeeper who misappropriated company funds into their own pockets that amounted to thousands. I will never get that money back because they are in hock up to their ears. Again, you have heard many times about the waste of money, time, and effort to sue people in debt. You may have been there yourself, where you wanted to sue someone and were told by your attorney, or at least an honest attorney, that the person is in so much debt with priority over yours, it's not going to be worth it. Because for starter, the attorney wants a $5,000 upfront, non-contingent, non-refundable, non-everything retainer going out of pocket, and this is only the beginning. You get the point. Now let's talk about the requirements for using equity stripping with controlled debt. We're going to have two separate LLC partnerships. A real estate LLC, this will be one LLC, own all your properties. The lender LLC is going to own the mortgage. They're going to make the loan. And this could be a Wyoming. By the way, Wyoming has very good laws of privacy, better than Nevada. And because this LLC is owning only paper, you could use an outside state like Wyoming without filing foreign entity registrations. So there's no risk, no high-risk assets. You know, when a company has only paper assets like a mortgage, as opposed to physical assets like property, there are no environmental hazards, no issues, no slip and fall, no personal injuries, no fires, no contractors, no tenants, and consequently no liability risk related to the above. But I have to tell you, the best wealth accumulation and tax benefits are from rental property, which you need to protect from these liabilities, and we're doing that with equity stripping Excel. Now, both LLCs will adhere to entity formalities, minutes of meetings, separate business bank accounts, no commingling, all documents in the name of the entity, signed by the owners, managing member, other formalities. And the reason why we want to do this, we want entity separation. The LLCs are separate and apart from you, and the two LLCs are separate and apart from each other. They are two independent, separate entities. Now, a less effective way than equity stripping to protect your equity, within your LLC is equity segmentation, namely an LLC for every property. Well, not only is this expensive and time-consuming, but it doesn't totally protect you. So let's go back to the 6 properties with 600,000 equity. Assume they have 100. It could be different, but for simplicity purposes, assume it's 100,000 equity with each of the 6 properties. Now we have 6 LLCs. We still have $100,000 equity. $10,000 of equity could be a target. And what's going to happen to this equity? Well, with upgrading and appreciation, it's going to grow larger. Now, for example, it's $200,000 equity of each LLC and a bigger target for claimants. With equity stripping, strips out all of your equity, including future appreciation, with accrued interest added to the loan balance. You'll see. Now, another less effective way than equity stripping is using your own separate management company, such as a corporation, to deal with the tenants, the suppliers, the vendors, etc., instead of the entity that owns the real estate. And this is taught somewhat on the circuit. It does have some merit to it, at least at face value, but there are 2 potential drawbacks. On the legal side, it may not protect you because in a legal action, at least a decent attorney, they're going to sue everyone. The management company, the owners, and they're going to figure out who's this management company working for, you or the entity that owns the properties. And on the tax side, there are IRS passive loss limits. You have to be aware that if this separate management company, even if you own the company, the entity, does too much to you as a real estate LLC manager, then you may be too passive and thus may not be able to currently deduct your rental property losses against your other income because of the passive loss limits of Code Section 469. There are several tax court cases where this has unfortunately happened, with the owner losing thousands of dollars. And this is discussed in my Renaissance Gold Mine tax course. Now, with equity stripping, with the protection of equity stripping, your real estate LLC will be doing the managing and therefore can sidestep such passive loss limits so you can fully deduct rental property losses against your other income without limits and pocket the tax savings. So equity stripping also saves you taxes. So let's look at the valid secured debt between the 2 separate state statutory entities, the 2 LLCs, the real estate LLC, the lender LLC. This is what it looks like. You have no equity. The equity is in the lender LLC, apart from claimants and their attorneys. Now let's see how this all happens with a step-by-step example. And we're going to see how it occurs between the 2 LLCs, assuming you don't have the $200,000 cash, to contribute to the lender LLC to make the secured loan. The 4 players here, Jason and June, they're the investors, they're the LLC members. Second player, an outside lender who's going to provide the cash for the equity stripping loan. Third player, a real estate LLC, owns all the real estate. And 4, a lender LLC, owns the paper, makes the loan. Now my students, Jason and June, JJ, they're 50-50 owners of 6 properties with equity of $600,000 that they need to protect. And they intend to acquire more properties and more equity. Now, they first contact an attorney by the name of Harvey Snodgrass. He advised an LLC for each property, or 6 LLCs, and the fee, $6,500 setup, $6,000 annual maintenance fees, $12,500 total first year. Ooh. Now, Harvey's plan is a new LLC for each newly acquired property and perpetual fees for his pocket. So it is a plan, an annuity plan for Harvey, not you. Well, JJ's solution is equity stripping Excel ESE. Now, Jason and June, they could use their own funds, but instead they personally borrowed the $600,000 from an outside lender who could be a hard money lender. It could be someone's IRA, a home equity, whatever. Now, this personal loan is outside of the LLCs. The LLCs have nothing to do with this loan. That's important. This personal outside loan will not be difficult to get because it will be paid fairly quickly. In fact, this all could be done in a day, in actually a couple hours. JJ transfers the $600,000. Now, JJ's Jason and June. They transfer the $600,000 to the lender LLC as a tax-free capital contribution to the lender LLC. So the lender LLC now has the $600,000 in their business account. Now, in the meantime, all arm's length loan documents completed and executed, loan applications, affidavits, loan approvals, recorded mortgages or deeds of trust. When we say arm's length, just like you're dealing with an outside bank or lender. These are blanket loan documents that encumber all properties in the one real estate LLC. Here are the loan terms. This is a second junior mortgage. It's a recourse loan with personal liability. It's a demand loan with a 30-day call provision, meaning the lender LLC with 30-day notice can call the loan. And if the real estate LLC don't pay, they can foreclose. We'll show you later where that may come in handy. There's no payments, including no interest payments, so this does not affect their cash flow. But legally, interest at market rates are going to be accrued and added to the loan balance. The loan balance is actually going to get bigger. And tax-wise, the same interest is imputed with, in accord with IRS regulation. We're going to do everything right here. Now, imputed is a paper entry under IRS regulations. It's not a cash entry. It means that the lender must report the interest as ordinary income, as imputed. Now, this is not so bad, guys, because if the lender LLC reports the interest, well, then likewise, the real estate LLC will deduct the interest. So this IRS imputed interest, a paper entity, yes, the lender LLC reports the interest, but the real estate LLC deducts the interest. But this is why we use flow-through entities like LLCs, not corporations, because this washes out on your 1040. So it's a wash, yet it's legally correct. We comply totally with IRS regulations. The entire loan process is done in written formal manner via entity formalities, minutes of meetings, company resolutions, etc. With the $600,000 in their account and all documents executed and recorded, the lender LLC transfers the $600,000 to the account of the real estate LLC. This is the making of the actual secured loan from the lender LLC to the real estate LLC. The $600,000 non-taxable loan proceeds are now in the account of the real estate LLC. So they have the money. Now, the real estate LLCs are, when I say they, I mean the real estate LLC, and their original purpose of the loan was for business working capital, which you need, and this was done by a formal resolution. Now, after all, the real estate LLC decides they don't need the funds, decided by another formal resolution. So the real estate LLC distributes the fund out of their account to Jason and June, the members, as a tax-free partnership distribution. This is tax-free because the partnership, its flow-through of the tax-free borrowed funds remain tax-free to the members under Code Section 731. Now, with corporations, this may be taxable. C or even S corporations. That's why we use the LLC partnerships. We cover all sides, the legal side and the tax side, and of course the IRS side. So the real estate LLC check, $300,000 to Jason, tax-free, $300,000 to June. Now, what does JJ do with the $600,000? Can you guess? Yes. They use the $600,000 to pay off the original outside lender personal loan. They're paid off. They're satisfied. They're out of the picture in a very short time. But what do we still have? We still have the valid secured debt between the two separate statutory entities, the real estate LLC, the lender LLC, right there. You can see it. You know, initially you don't have to worry about the detail. What you need to know is the bottom line. The real estate LLC has a big fat real lien on all its real estate, eroding the property equity and warding off claimants along with their money-lost lawyers the way a cat scares off rats. And a pun is intended. All right. So the bottom line, look at this. Jason and June totally protect their equity and save $12,000. Now, there was some cost to this. You know, let's say, and I'll pick a higher number. Let's say it costs $2,500. They're still $10,000 ahead. And they're totally protected effectively. Now, note, you can recycle, you know, suppose you don't have this, you can't get $600,000. Suppose you can only get $150,000. Well, you can recycle smaller amounts of money to fund the equity stripping loan of a larger amount. So, for example, $600,000 was needed to strip out the equity. Well, we could only get $150,000 from the outside lender. So we could recycle $150,000 4 times to get to the needed $600,000 equity stripping loan, but we only need $150,000 to do we just do the loan documents once. It's still done once for the total $600,000. We just recycled $150,000 4 times. Or if we can only get $60,000, we would do that 10. So you have to understand, this is a circle of money recap, which starts and begins with the outside lender. It starts with the outside lender who lends to the LLC members, who contribute to the lender LLC, who lends to the real estate LLC, who distributes to the LLC members who pay off the outside lender. Now, the above could be done in 1 day or less and through escrow. You know, if the outside lender is worried about getting their money back, hey, they could hire an escrow agent to do this, and this could all be done through escrow, so they're totally protected. And it's still all legal. Now, I have sources of zero interest unsecured loans if you need to fund the equity stripping loans or do whatever you want with the cash. Now, several times a year we run webinars on the Established program, or you can email us if you want to know. Now, an alternative to actual cash borrowing is a pre-approved line of credit, like a HELOC loan, with the lender LLC for at least the amount of the equity. Now, to protect the entire loan, the lender LLC, via a mortgage, records the entire credit obligation in the public records for creditors to painfully see. Now, there's no borrowed money here that are transferred, but available via pre-approved draws. This is not a phony lien if properly documented. All right, let's talk about the Roman shield strategy. Now, the ingenious ancient Romans had a military formation that was covered with shields. Now, no one shield would totally protect them, but collectively, they were almost an impenetrable wall. Same thing. You need multiple shields to protect you on all sides with powerful but cost-effective Roman shields. What are these shields? Well, you need an entity like an LLC. You could also use another shield, land trust, or other trusts, liability insurance, and of course, equity stripping Excel. Let's talk about the LLC chain of ownership. Who's on first? Who owns what? Well, the LLC, a separate entity, owns the real estate, not you. What do you own? You own the membership interests of the LLC, the units or the shares. Now, your membership interest of the LLC, the shares are an asset in your state, have value, subject to probate upon death and to attachment by creditors during life or death, gets you either way. The solution is the lender LLC is going to place a UCC lien, a Uniform Commercial Code lien, every state has it, on your shares of the real estate LLC as additional security for the equity stripping loan, in addition to the mortgage lien on the LLC's properties. Now, a UCC lien is a lien on personal property, the way a mortgage or deed of trust is a lien on real property, to secure performance and protect the lender. So let's look what we have. Your real estate LLC equity is protected with an equity stripping via recorded mortgage. Your LLC shares, which is also equity, is also protected with equity stripping via a recorded UCC lien. I mean, you are lean and mean, you and colossal shield of protection. And you can use the same UCC lien on your other assets, your vehicles, your savings, bank accounts, stocks, bonds, expensive jewelry, coin collection, antique, all these personal valuables, which, by the way, all have value subject to attachment by the local sheriff legally entering your home and seizing your family assets. Well, a properly recorded UCC lien gives notice to the world that the above assets are encumbered and no one can touch the asset until the loan obligation is satisfied. What a winner. You can also use equity stripping with the same lender LLC to protect the equity of your most important yet vulnerable asset, your home. Unless you're in a state with an excellent homestead exemption, named Florida or Texas, your most valuable and important asset, your home, is not protected. And then there are second homes, which even Florida or Texas or any homestead exemption does not protect, but equity stripping will. So your primary home, your secondary home also protects that. Let's talk about some equity stripping Excel misconceptions. Equity stripping does not affect your credit report. No, you're the lender. You're not going to report it. Your cash flow, there's no payments. Your equity. You still have your equity, just the pockets change. Refinancing. If you want to refinance with an outside lender, you could subordinate the equity stripping loan to a junior position. Or doing a 1031 exchange or operating your business, equity stripping doesn't affect anything except protecting you. You don't have to pay back the loan until the property is sold or exchanged, which could be much later. Now, a tax alert, the one extinguish the debt by the lender LLC forgiving the debt. This is ordinary, non-cash, phantom income to you, a tax disaster. Don't do it. You don't have to. So we cover the full gamut, the tax ramifications too. All right, now what happens if they still sue the real estate LLC, even though it has no equity? You might get some nutcase that tries that. Well, then the lender LLC, remember we have that 30-day call provision, is going to call the note in 30 days. When the when the real estate LLC can't pay, they foreclose, repossess the property, and now the real estate LLC has zilch, niente, nothing, nada, whatever language you want to use, nothing. By the way, I've never known this to happen, but it's an important safeguard that's there. Suppose they want to sue the lender LLC. Well, the lender LLC is not the origin of the lawsuit. Understand, the lender LLC has nothing to do with the properties. Unlike using a separate management company who does manage the properties, this is not so with the lender LLC. Plus, it's a Wyoming LLC for privacy. And then if somehow a claimant were to attach, sue the lender LLC successfully, I don't know how, but if they were, then they would get the one asset that the lender LLC is the note, the mortgage note. Now, this mortgage note has imputed interest, which the claimant must abide by the terms of the note, and they have to report that interest to the IRS, and it's phantom income. The one example we use, it's $100,000 interest for the year, 30% bracket. That's $30,000 the claimant would have to pay $30,000 to the IRS, and they never got any cash because it's fat. This is why we call these poison pills. Gulp. All right. The real estate LLC and the lender LLC as commonly owned entities. That's true, but they're separate from each other via those formalities that we talked about. And then you can put the shares of the LLCs in different trusts. Your real estate LLC shares could be in Trust 1, and your lender LLC shares could be in Trust 2. Roman shields of protection. Too complex, too expensive. What? Next to this, and this, and this, and this? Hey, I'm not saying it's totally simple. You know, if you want simplicity, don't be in real estate. But it is much simpler, much easier than all those convoluted entities. Perfectly legal, following my system. You use state statutory entities, LLC, separate and apart from you and each other. Arm's length recorded loan documents. There is no authority by statute or case law in any state that any court ever denied a valid debt created by a controlled company. Got that, guys? Such as the lender LLC. And you report it to and comply with the IRS. Who imputes interest? Next to nobody, but you did. Let me tell you something. One of the most important entity formalities you can do to keep claimants and their money lust lawyers out of the picture, off your back, is complying with the IRS, because they are a powerful, maybe they're infamous, but they are a powerful federal agency who in effect said okay to your equity stripping loan. Try and crack that, baby. And the burden of proof is not on you, but on the claimant and their lawyers for them to prove that this well-documented loan reported to the IRS. You go, oh, forget it. And why not do equity stripping? You know, as entrepreneurs, we always look at the worst-case scenario, which is some deep-pocket, ultra-aggressive claimant and money-lust, creepo lawyer somehow undoes your equity stripping. I don't know how, but if it happens, there's no jail, there's no penalty. You have everything to gain, little, really none to lose. Are there any superior alternatives than equity stripping to protect your equity? Equity stripping protects all your equity, all your assets. It's less costly, less time-consuming, less burdensome. And watch this, guys. It's never been collapsed. Equity stripping, to the best of my knowledge, has never been collapsed. Now compare when hundreds of corporate veils have been pierced. Family limited partnerships are being thrown out of tax court. Land trusts have been undone. Revocable living trusts are collapsible. Insurance does not cover everything. Now, not that these are all necessarily bad. They're not, and some can even be combined with equity stripping, like LLCs, trust, and insurance. It's just that equity stripping Excel is such a superior wealth protection strategy. Done properly, it is perfectly legally, it virtually has no disadvantages. Let's do a total ESE recap. Your investment in real estate in the LLC, no value. Your shares, your units of the real estate LLC, no value. Your home, no value. Your personal valuables, but they have no value. Other investments, no valuable, no value. Business assets, no value. You are worthless. I mean, who wants to be with you? You're absolutely worthless. I mean, now let's create another Roman shield. The assets can be protected by transferring them to a trust. This is something I teach, a life estate trust. This is much more, does everything a revocable living trust does, avoid probate and all that, but it also gives you asset protection. So you could put your ownership shares of your entities, your vehicles, your savings accounts, your personal valuables, your home, your second home, your other personal property into this life estate trust. So let's see what we have. This asset protection trust now owns all these assets, which have no value with equity stripping Excel. Now you are totally worthless and untouchable. You own nothing, yet control everything. And this equals totally avoiding expensive lawsuits so that they never, ever happen in the first. The mere existence of a controlled lender's lien will deter all but the most determined judgment creditor from attempting a forced sale because there is likely to be no value for the creditor to realize. Christopher Reiser, Asset Protection Attorney. Look, you have two LLCs to protect you with any number of properties in any number of states. So if you own or flip 10 properties with this system of two LLCs, let's look at it. You only need 2 articles of organization versus 10. That's your application to set up the LLC. 2 sets of minutes versus 10. 2 sets of resolutions versus 10. 2 operating agreements versus 10. 2 sets of accounting records versus 10. 2 bank accounts versus 10. 2 federal tax returns versus 10. 2 state tax returns versus 10. 2 setup fees versus 10. 2 annual state fees ever versus 10. You literally save thousands in legal fees, accounting fees, state fees, bookkeeping fees, bank fees, you save, plus the paperwork and your valuable time. Anytime you accumulate equity, build it up, save it, move it, keep it. You accomplish this best with the ingenious Equity Stripping Excel. All right, want more information? Probably yes. Okay. Equity Stripping Excel is my superior asset protection system, shielding all your assets without the cost and complication of multiple entities. You're going to save thousands in all kinds of fees. It is authored by myself, Aiello, and Bill Knoll, a brilliant attorney CPA. Let me tell you something. With our combined credentials, you have over 45 years of legal, tax, IRS, and real estate experience on your team. Equity Stripping Excel system shows you step-by-step and an easy-to-follow format to do equity stripping to protect all of your assets with your own funds or temporarily borrowed funds without any funds with total legal and tax compliance. It includes an easy-to-follow manual with step-by-step instructions, 6 audio CDs with tracking, all necessary documents you need to implement the system. The documents are blank on CD-ROM forms filled in step-by-step instructions. We have equity stripping to protect your keepers, flippers, lease options, to protect your home, your second home, to protect your personal valuables from sheriff attachment or any attachment. Equity stripping with owning properties in different states, we tell you that. When more than 2 LLCs will benefit you. Equity stripping with the series LLC. Equity stripping with land trusts, all these great combinations. How to add new properties with equity stripping with minimum documents and no additional loan funds. A real-world case study with step-by-step procedures and filled-in forms and a whole lot more. You have the licensing rights are exclusively for you on this intellectual property. As a licensee, you could use the equity stripping for your exclusive use, and you could also share it with your advisors with written permission from us. And you have the equity stripping asset protection Q&A helpline, specifically for your equity stripping asset protection questions. You know, if you don't have this system, guys, I cannot answer these types of questions effectively. Nowhere else will you find this awesome yet inexpensive asset protection system. It is the only system of its kind on this powerful equity stripping topic. Al, your equity stripping course is a lifesaver. It is so much simpler than using all those entities that so-called asset protection experts teach, and she goes on to list them. You know who they are, and much less expensive. Thank you for putting together such a great system. That's Muriel from Florida. And I have other testimonials, too. Now, the retail value is $5,000. Look, we're not going to charge you that. But think about this. Jason and June were going to pay $12,500. Well, they saved that and totally protected their equity. Now, would you pay $5,000 to get $12,500? Sure, the answer is yes. That's about a 250% return on your money. But let's cross that out. Cross out the $4,000. We've also sold it for $14.95. We're going to make it only $8.95, and it's tax deductible. So you're really not going to pay $895. Imagine $895, less than $1,000, but you're going to save in all those legal fees and state filing fees, accounting fees, and the savings from it. Tell you what, guys, cross out the $895. We have a special offer that is less than $895 that's going to expire soon. If you want to check it out, and I would check it out now because it's limited time, go to this link, www.yourequityprotection.com. Go to it, yourequityprotection.com. This is a limited time special offer. I want to thank you for having me on this presentation. Again, one more time, yourequityprotection.com. Go to that link, go to that site, and it has a limited time special offer that is even going to be less than $895, which is a bargain as it is. Your Equity Protection. Thank you.